This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, this week you said it is time to get contrarian. Tell me what you mean by that.
Well, time to swim upstream, if you want to put it that way. I just think that things have gotten too many people on the same side of the boat. Everybody seems to be negative about the economy. And we presented some survey type evidence of that. Everybody seems to be negative. And I think there's just this, we're kind of reaching this point. Well, it's not just that, it's a number of things. It's everybody's long energy stocks. Everybody's long commodities now. All these things are just crowded trades. And we know that these things can only go so far. And at some point they reverse. Pinpointing that, yeah, it's pretty hard. But I think we're probably at that point.
Well, I mean, how many times over the 30 years you and I have been in this business have we said that investors generally move in a herd and the herd is generally wrong? That sounds like where we are. What you just said, put that into the consumer sentiment stuff that you're seeing right now.
Well, yeah, it isn't a herd, but that's the thing though, is the herd is often right for a long time. And so you kind of have to work on both pieces of that. Listen, the consumer sentiment survey is just extraordinarily negative right now. That's the University of Michigan Consumer Sentiment Survey, a 59 and change reading in March. The early April reading, by the way, had jumped up to 65, so it did improve. That was a preliminary reading. You'll see the final at the end of the month. But that 59 reading is just extraordinarily low. We've never seen a number that low that was outside recession. And obviously we're not in recession. So, if you just think of it as a contrarian type indicator, if you go back and look at history, when it's been this low, it's been a pretty good time to buy stocks. And that goes back to the 1970s. And in 1975, I think was a very low reading that was after the 73, 74 bear market. There was a low reading in 1980 coming out of recession or in the middle of that first recession. Of course, you got a double dip and it went back down in 82. But that 82 reading, you were buying in April of 82. Well, August of 1982 was the all-time, that was the greatest buying point for a generation of investors, where we went on this very, very long Reagan era bull market that extended into the 90s, obviously. So these low readings in sentiment are generally are going to be points where you want to be buyers of risk assets, not hunkering down like everybody else is. Everybody else right now is very negative. Although this consumer sentiment survey, as I mentioned in the thing, it is very political. Right now, Republicans have a extraordinarily dour view of the economy, whereas Democrats are a little more sanguine. I mentioned another survey. There was another survey too out last week that showed that a rough 49% of Americans don't think any jobs were added in the economy over the last year. And I look at that and I'm like, oh my God, how can you possibly think that? Do you not read the news? We added 6.5 million jobs. I'm not one who credits presidents or politicians with that kind of thing. But the fact that you don't even acknowledge 6.5 million new jobs in a year tells me that your view of the world is so dramatically skewed that you don't have a grip on reality. And I don't know whether those were Republicans or Democrats or who they were, but 49% of this country is just completely clueless about the economy. So anyway, the point is that the sentiment survey is showing very negative sentiment about personal situation more than anything. Consumer sentiment survey talks about, inflation, gas prices, pocketbook issues, I suppose is a good way to put it. And Americans just are not very happy with the way things are right now.
Well, let's take this contrarian philosophy that you've been talking about and dig down into some specifics. For the individual investor, what does that mean, number one, in stocks?
Well, I'm not saying that you need to back up the truck and buy a bunch of stocks or buy the S&P 500. I'm still not a big fan of the S&P 500 because I think the top 10 stocks in there are way overweighted and quite expensive still. But I do think it's kind of extraordinary when you consider what's happened this year, just since the beginning of the year, with the war in Ukraine and the Fed rate hikes and the rise in interest rates and all these other things going on. It's extraordinary to me that the S&P 500 is down a mere 7%. If you had told me at the beginning of the year all these things were going to happen this year and that stocks wouldn't go down, I would think you were, smoking something. But it's been kind of extraordinary. And when in markets, if you get bad news on something, whether it's the market as a whole or an individual security, whatever it is, and the thing doesn't go down, that tells you something that whoever wanted to sell has probably already done it. So I think that you can probably be starting to, you can start to look for stocks to buy. I'm not saying, again, don't back up the truck and buy the S&P 500. I would actually probably prefer, and we continue to favor the value stocks. We think that's going to continue. That's a trend that's just starting and probably will continue. I think you can also look at some individual equities and some individual individual sectors, maybe even add a little bit of international here. Look, the dollar's been strong. International has underperformed because of that, and it's hard to buy international when the dollar's strong. But we are at the top of the range of the dollar index. It's possible that you're going to see a move back down. I think that things are so cheap outside the United States that you can take a little bit of a risk there. And if you're wrong, I don't think you lose much. So like I said in the piece, I think you've got to be very, very careful about where you apply contrarianism. Sometimes the crowd is right. I don't know. An example I think is healthcare stocks. Healthcare stocks are crowded trade. There's a lot of people. That's an area where people have been drawn to because it tends to be a defensive sector. On the other hand, the pharmaceutical sector, biotech stocks, healthcare in general, that's an area of the market that is undervalued relative to the market. It's got a below market PE and probably and a growth rate, an earnings growth rate that's higher than the PE. That to me is attractive. So I think the crowd may be right on that one. On the other hand, the crowd is also heavily into utilities, where I see very high valuations. Actually, dividend yields that are not that impressive, and I don't see the growth. Why would you pay a higher PE for utilities and a lower level of growth than you would for pharmaceutical stocks? That makes no sense to me. So I think you maybe fade the utilities and maybe concentrate on the pharmaceuticals or the biotechs or something like that. So I think you have to be selective about your contrarianism is the point.
All right, under this contrarian umbrella, talk to me about the bond market.
Yeah, bonds is a little tougher, I think. We did extend duration a little bit recently. We kind of felt like that the 10-year was getting to a point where it probably has done about what it needs to do. The rate hikes for this year are priced in. I don't even think they're going to be able to do all the rate hikes that are priced in. We'll see. And I think too that with everybody negative on the economy, maybe the economy is not as bad as people think it is. And if it's not, then to expect a big rally in bonds probably is not all that wise. We'll see how this goes. I mean, obviously what goes on in the bond market is going to have a lot to do with how inflation goes here too. We do not seem to be at the end of this inflation cycle yet. I do think it's somewhat vulnerable on the commodity side in particular because the dollar has been strong, but we've got what's going on in China and Shanghai with the big shutdown there because of COVID. That's going to have an impact on supply chains again. And I don't, I hear people saying that, oh, they're doing that on purpose. I don't know if they are or not. I can't get into that. I just know that it is. So we're going to see some continued supply disruptions, I think, in some goods. On the other hand, maybe that's not a bad thing at this point. We do have inventories building, and we know that retail sales and goods consumption is starting to pull back some. So maybe it's not that big a deal that the supply chain is disrupted a little bit on the goods side. Anyway, we're also not done with Ukraine, obviously. So natural gas prices hit a new high this morning. Crude oil is up again today. So those things are not quite done. But I do think we may have seen the high on crude. So, there's just various things going on like that I think you got to be aware of in the bond market where, maybe this inflation's got a little bit more to run.
And then the last thing today, you touched on it just a little bit so far, but talk to me about contrarian and commodities.
Yeah, look, the Bank of America Fund Manager Survey has them the longest they've ever been in commodities, net long. Everybody's obviously jumped on the commodity trade here. But we also know the commodities are extraordinarily volatile. And so a reversal there would not be shocking. You get some kind of sudden resolution of Ukraine or whatever the case may be, anything that moves us closer to a supply demand balance is going to have a big impact, an outsized impact on commodity prices. Look, I think there's a lot of reason to think that commodities longer term could be a positive place to be. I'm not saying we don't do all or nothing here, as we've talked about many times. So I'm not saying to bail on it. I think the idea that we're going to shift to electric vehicles, for instance, and that's going to create a continued demand for copper and lithium and various other types of metals is probably a good instinct. Although I do think that the electric vehicle revolution, or what do you want to call it, maybe is not as grand as people think it is, but that's okay. So I think there's some reasons to think that there's going to be continued demand there. But, commodity markets are very sensitive to this stuff. An old saying that the cure for higher prices is high prices, because more supply comes on. It takes time, but it does happen eventually. So anyway, I'm not saying again that commodities are about to collapse or anything like that. I just think that everybody's already in the trade. It's not a surprise. If you own commodities here, you're in the consensus. And I always get uncomfortable when I'm doing the same thing that everybody else is doing. As I said in the piece, you can't get outstanding results doing the same thing that everybody else is doing. You got to do something different. So I think that the something different here is to be a little bit contrarian.